Hello. Today I will tell you about a company with big dividends and growth potential. Medical Properties Trust Incorporated is a real estate investment trust specializing in the investment, ownership, and leasing of healthcare properties. It has operations in the US, Europe, Australia and South America. The trust's portfolio consists of 447 properties. The trust operates in the health sector, which is less exposed to volatility because of macroeconomic pressures. The new deals will bring in additional cash flows, which will help provide a good level of dividend yield. A further increase in interest rates would increase the amount of rental payments without affecting the cost of servicing own debt. Reason 1. Low impact of economic cycles and rate hike protection mechanism. With Medical Properties Trust specializing in properties used as healthcare facilities, the risk of significant deterioration in the financial condition of counterparties is reduced. Firstly, healthcare is one of the areas least affected by recession. Despite macroeconomic conditions, the demand for health services will remain at roughly the same level, as the elimination of health problems is a primary human need. Secondly, the demand for healthcare facilities is growing naturally due to changing demographics. In addition to natural population growth in the U.S., U.S. Census Bureau also reports an aging population trend. The proportion of people over 65, in dark blue in the graph below, will reach 1/5 of the population by 2040. However, we can see that the trend has been going on for more than 40 years. The aging of the population, in turn, leads to an increase in the frequency of visits to healthcare facilities. Thus, both factors indicate that Medical Properties Trust tenants are less affected by economic cycles. With the U.S. Federal Reserve targeting rate increases despite the recession, it is important that the trust is protected against rate increases through an escalation mechanism. Under the terms of the agreement, if rates rise in the economy, so does the cost of rent. In 2023, this mechanism will increase rents by 4.4%, the equivalent of $57 million. Reason 2. Active management of the property portfolio. The trust's ongoing business projects also add to the reassurance. In October 2021, Medical Properties Trust provided Springstone with $190 million in financing, mostly in the form of a loan, to acquire 18 psychiatric hospitals and received a minority stake in Springstone. At the end of August, the company announced that LifePoint Health had agreed to acquire a majority stake in Springstone Health OpCo from the current management group, based on a valuation of $250 million. The deal is expected to close in the first half of 2023. By that time, Medical Properties Trust expects to receive about $200 million in full payment on the loan, retain its minority stake in the stock and continue to lease Springstone facilities. In addition, LifePoint has agreed to extend the existing master lease for 8 general hospitals by 5 years to 2041. On September 7, Medical Properties Trust announced that it had successfully leased its Watsonville Community Hospital in Watsonville, California, to Pajaro Valley Healthcare District Corporation, and sold 9 general hospitals and 2 related buildings in California, Indiana, Nevada, and Pennsylvania to Prime Healthcare for $360 million. The proceeds from the above transactions will provide Medical Properties Trust with about $600 million of liquidity in the near term to reduce its debt burden and make certain profitable acquisitions. Reason 3. High dividend yields. One of the features of the REIT is its stable dividend payments. Currently, Medical Properties Trust's dividend yield has reached 9% per annum. At the same time, the payout ratio has averaged 87.62% over the last 5 years. The continued good level of cash flow coupled with the protected nature of the sector gives confidence in maintaining a high level of dividend yield in the near term. If we consider the Springstone deal now, we can see that over the year the trust has increased its investment portfolio from $15.65 billion to $22.29 billion, 72% of which is made up of general hospitals, which have the most stable demand regardless of the economic situation. During the same period, Medical Properties Trust grew its funds from operations, FFO, from $205.6 million to $274.9 million. The 12-month operating cash flow, TTM, for the latest reporting period ended June 30 rose from $693.8 million to $790.4 million. Net cash outflow for the same period fell from $4.46 billion to $2.60 billion. The trust has total debt of $10.14 billion and a debt-to-equity ratio, D/E, of 1.44x. Most repayments are post-2025. Of the total, only $1.32 billion is due in the earlier periods of 2023 and 2024. The interest coverage ratio is 2.83x. We said earlier that in response to the rate hike, the trust is increasing the cost of rents. Meanwhile, 89% of the trust's own debt is raised at a fixed rate. In terms of trading multiples, Medical Properties Trust Incorporated looks undervalued compared to its competitors, while offering a higher dividend yield. The minimum price target set by Deutsche Bank and Jefferies Financial Group is $15 per share. Barclays, on the other hand, has set a target price of $23. According to the consensus, the fair value of the stock is $12.05, which suggests a 41.07% upside potential. The current macroeconomic situation carries risks of financial problems for some medical companies, which may result in them refusing to lease the properties further. The realization of this case could negatively impact the trust's cash flow, thereby negatively impacting the amount of dividend payments and the value of Medical Properties Trust. Buy shares at a price of $12.05. Allocate no more than 2% of your portfolio for purchase. Sell when the price reaches $17. Thanks for watching this video. Subscribe to this channel, it will be even more interesting.